It might sound unbelievable, but I know firsthand that building wealth doesn't require a fortune to start. I saw it myself when $100 invested with discipline grew into millions over time. It's a lesson that has stayed with me. If I were starting over today with nothing but $500 a month, the very first thing I'd do is establish an unbreakable habit of investing. I want to emphasize not saving, but investing. There's a critical difference. Saving means putting money aside, often in a bank account earning next to nothing after inflation. Saving is necessary, of course, but it's not sufficient on its own. Money sitting in a savings account slowly loses purchasing power as inflation erodes its value year after year. Investing, on the other hand, means putting your money to work, buying ownership stakes in productive assets that grow over time. When you invest in stocks, you're essentially buying pieces of real businesses with real employees making real products that real customers pay real money for. Those businesses grow, their profits increase, and your ownership stake naturally becomes more valuable. The habit I would build, and I can't stress this enough, is automatic investment on the very first day of every month. Not when I feel like it, not when the market looks good, and certainly not after I've paid for everything else. No, this comes first. Before rent, before entertainment, before anything discretionary. The $500 goes into investments automatically, and I learn to live on what remains. This automation is absolutely crucial because it removes emotion and decision-making from the equation. You don't have to convince yourself to invest each month. You don't have to overcome the temptation to spend the money on something else. The money simply moves automatically, and you adjust your lifestyle to accommodate what is left. I learned very early in my life that the most successful investors are those who make investing non-negotiable. It's not something they do when it's convenient. It's something they do no matter what. Through good months and bad months, through market crashes and market booms, through job changes and life changes, the investment continues automatically. Now, let me tell you exactly where I would put that $500 each month. If I were starting over today with $500 a month, I would put every single dollar into a low-cost S&P 500 index fund, not individual stocks, not actively managed funds, not complicated strategies, just a simple, almost boring index fund that tracks the 500 largest companies in America. I know this might sound surprising, especially coming from me. After all, I've spent my entire career picking individual stocks. I've built one of the largest fortunes in history by identifying undervalued businesses and holding them for decades. So why would I recommend something as simple as an index fund? Well, it's because I'm being honest about what works for most people. Stock picking requires enormous amounts of time, knowledge, and a certain temperament. You need to be able to read annual reports, analyze competitive positions, evaluate management teams, and understand complex industry dynamics. You also need to remain rational when everyone around you is either panicking or euphoric. Most people simply can't do this successfully while also working a job, raising a family, and living their lives. An index fund, on the other hand, gives you ownership in 500 of the best businesses in America without requiring any of that work. You own a piece of Apple, Microsoft, Amazon, Google, Johnson & Johnson, Procter & Gamble, and hundreds of other excellent companies. As these businesses grow and prosper, your investment grows right along with them. The S&P 500 has returned approximately 10% per year on average over the long term. It's remarkable how a consistent investment requiring essentially no effort can yield such returns. I've seen the math play out, and it's truly eye-opening. Imagine investing $500 a month, and let's say you average a 10% annual return. After 5 years, you'd have around $39,000. After 10, approximately $130,000. Extend that to 20 years, and you're looking at roughly $380,000. And after 30 years, over $1 million, all from $500 a month. That's the power of consistent investing combined with compound growth over time. And that's assuming you never increase your monthly investment. If your income grows and you gradually increase from $500 to say $700 a month, the final number becomes substantially larger. The earlier you start or the longer you invest, the more dramatically the number grows. Time, I've learned, is your greatest asset. A 25-year-old who invests $500 a month until age 65 giving compounding 40 years to work its magic at 10% annual returns, could end up with over 3 million. It's not magic, but simply the result of consistent investing over long periods. The power of compound growth isn't always obvious, and I find most people don't truly grasp it until they see it in action. In the early years, the growth seems painfully slow. After 1 year of investing $500 monthly at 10% returns, you might only have about $6,300, with only $300 of that being investment returns. The rest is simply your contributions, and it hardly seems worth the effort. But compound growth is exponential, not linear. Each year, your returns generate their own returns. After 10 years, you might have contributed $60,000, but your portfolio could be worth over $100,000. The investment returns now exceed your contributions, and the snowball is building momentum. After 20 years, you might have contributed $120,000, but your portfolio could exceed $380,000. Your investment returns are now generating over $30,000 per year, more than half of what you contribute. The snowball is rolling downhill, gathering mass with every turn. After 30 years, you might have contributed $180,000, but your portfolio could exceed $1 million. Your annual investment returns exceed $100,000 per year. The snowball has become an avalanche, and you're earning more from your investments each year than most people earn from their jobs. It starts slowly, almost imperceptibly, then it accelerates and becomes unstoppable, but only if you give it time. Every year you delay is a year of compounding you will never get back. Albert Einstein is said to have called compound interest the eighth wonder of the world. Whether he actually said that or not, the sentiment resonates with me. Something almost magical about the way money multiplies when left to grow undisturbed over long periods. It is the closest thing to a guaranteed path to wealth that exists in the financial world. Now, let me talk about the low-cost part of my recommendation, because this is critically important. When you invest in a fund, you pay fees expressed as an expense ratio, a percentage of your assets that the fund company takes each year to cover their costs and profits. The difference between a high-fee fund and a low-fee fund might seem small, perhaps 1% per year, but over decades, that difference compounds into an enormous sum. Imagine two investors who both invest $500 a month for 30 years, both earning gross returns of 10% before fees. Investor A uses a low-cost index fund with an expense ratio of 0.03%, while investor B uses an actively managed fund with an expense ratio of 1%. After 30 years, investor A has approximately $1 million, while investor B has approximately $900,000. That 1% difference in fees cost investor B over $200,000, gone to fund managers who almost certainly didn't beat the index anyway. This is why I specifically recommend low-cost index funds. Companies like Vanguard, Fidelity, and Schwab offer S&P 500 index funds with expense ratios near zero. You capture essentially all of the market's returns rather than giving a substantial portion to fund managers. I have said many times that most investors would be better off in a low-cost index fund than trying to pick stocks or hiring someone to pick stocks for them. Over the past 15 years, more than 90% of actively managed funds have underperformed the S&P 500 index. These are professional investors with teams of analysts, sophisticated computer models, and access to company management, and they still cannot beat a simple index fund. You cannot control the market, you cannot control the economy, but you can control the fees you pay. Keeping fees low is one of the few guaranteed ways to improve your investment returns. Let me talk about something equally important: how you behave as an investor. This will determine your success or failure more than any other factor. The biggest threat to your wealth is not market crashes or economic recessions, but your own behavior. The average investor earns returns far below what the funds they invest in actually generate. How is this possible? Because people buy and sell at exactly the wrong times. When the market is soaring and everyone is making money, greed takes over. People pour money into stocks at high prices, convinced the good times will continue forever. When the market crashes and panic spreads, fear takes over and people sell their stocks at low prices, convinced the world is ending. Buy high, sell low. It is the opposite of what intelligent investing requires, yet it is what most people do. If I were starting over with $500 a month, I would commit to never selling based on market conditions. Never. The money goes in every month, regardless of whether the market is up or down. I do not check my account obsessively. I do not watch financial news channels. I remember the financial crisis of 2008 and 2009 so vividly. The market plummeted, retirement accounts were decimated, and the news was filled with predictions of a new Great Depression. Fear was palpable. I saw so many investors sell their stocks then, locking in huge losses because they simply couldn't bear to watch their portfolio shrink day after day. They convinced themselves it would only get worse, that they had to protect what little remained. But what I also remember is this: the investors who kept buying through the crisis, who consistently put their money in the market month after month, even as prices fell, they did extraordinarily well. They were buying shares at bargain prices, and when the market recovered, as it always does, those shares exploded in value. The S&P 500 bottomed out in March 2009 and then delivered one of the greatest bull markets in history. Those who sold at the bottom missed the entire recovery, while those who stayed the course saw their wealth multiply many times over. That's why I believe behavior matters more than stock picking or market timing. The investor who consistently invests through good times and bad will almost always outperform the one who tries to time the market, even if that person is more intelligent or has better information. So let me share a specific strategy for managing your behavior during market downturns. When the market's falling and you feel that urge to sell, try to do the opposite. Increase your investment if you can. If your normal investment is, say, $500 a month and the market drops 20%, try to invest $600 or $700 that month. I know it feels counterintuitive. Every instinct tells you to protect what you have when prices are falling. But falling prices are actually good news for someone who is accumulating shares. You're essentially buying the same businesses at lower prices. Your $500 buys more shares when prices are down than when they're up. Think of it like this: if your favorite store had a 20% off sale, would you avoid the store because prices had dropped? Of course not. You take advantage of the lower prices. Yet when stocks go on sale, most investors run away instead of taking advantage. Now, as your wealth grows, your strategy can evolve. When you're starting out with just a few thousand, simplicity is key. One index fund is really all you need. There's not much point in diversifying across multiple funds or asset classes when your portfolio is small. The benefits of diversification are outweighed by the complexity and the temptation to tinker. But as your portfolio grows into the tens of thousands and eventually hundreds of thousands of dollars, you can begin adding additional elements. Once I had accumulated perhaps $50,000, I added an international stock index fund. Maybe 20% of new contributions would go to an international fund, while 80% continued going to the S&P 500. This provides expo to companies outside the United States, which occasionally outperform American stocks for extended periods. And once I had accumulated around $100,000, I considered adding a small allocation to bonds, maybe 10% of the portfolio in a total bond market index fund. Bonds provide stability during stock market downturns and generate income that can be reinvested. They reduce the overall volatility of the portfolio, which makes it easier to stay the course during difficult periods. But I want to be clear, these additions are refinements, not requirements. An investor who simply puts $500 a month into an S&P 500 index fund for 30 years and never touches it will do extraordinarily well. The additional diversification provides modest benefits, but it isn't essential. The core principle remains the same throughout. Invest consistently in low-cost funds that provide broad market expo. Don't try to pick individual stocks or time the market. Control your behavior and stay invested through volatility. Let compound growth work its magic over decades. Now, let me address some common questions and concerns that might be running through your mind. What if you can't afford $500 a month? Start with whatever you can afford. $100 a month is better than nothing, and $200 is better than $100. The principles work at any amount. The key is building the habit and maintaining consistency. And as your income grows, increase your investment amount. What if you need the money for an emergency before you even begin investing? Build an emergency fund of 3 to 6 months of expenses in a savings account. This money is not for investing. It's insurance against life's unexpected challenges. Once you have this cushion, you can invest with confidence, knowing that short-term emergencies won't force you to sell your investments at inopportune times. What about paying off debt? High-interest debt, like credit card debt, should be paid off before you begin investing. If you're paying 18% interest on credit card debt, paying off that debt is equivalent to earning 18% on your money, a guaranteed return better than any investment can offer. But once high-interest debt is gone, you should invest rather than aggressively paying down low-interest debt, like mortgages. The math often favors investing when interest rates are low. What if you're older and don't have 30 years to start? Well, start anyway. 20 years of compound growth is better than 10. 10 years is better than 5. And 5 years is better than keeping your money in a savings account earning nothing. The best time to start investing was 30 years ago, but the second best time is today. What about retirement accounts like 401k plans and IRAs? Use them. These accounts provide significant tax advantages that accelerate your wealth building. If your employer offers a 401k match, contribute at least enough to capture the full match. That's free money you shouldn't leave on the table. I sometimes think people don't fully grasp just how powerful tax-advantaged accounts really are. With a traditional 401k or IRA, your contributions are tax deductible. It's like the government is subsidizing your investment. The money then grows tax deferred, meaning you don't pay taxes on dividends or capital gains each year. You only pay taxes when you withdraw the money in retirement, hopefully at a lower tax rate. In a Roth IRA, you contribute after-tax money, so there's no upfront tax deduction, but the money grows completely tax-free. When you withdraw in retirement, you pay zero taxes on the gains. If your $500 per month grows to $1 million over 30 years, you can withdraw that million without paying a penny in taxes. Imagine investing $500 per month in a Roth IRA for 30 years, earning 10% annually. You contribute a total of $180,000. Your account grows to over $1 million. As the gain of over $900,000 is completely tax-free. Now imagine instead you had invested in a regular taxable account. You would pay taxes on dividends each year, reducing your returns. When you sell, you'd pay capital gains taxes on the $900,000 in gains, maybe at a 15% capital gains rate, which is $135,000 in taxes, or even at a 20% rate, which is $180,000. The Roth IRA saves you well over $100,000 in taxes. That's real money that stays in your pocket rather than going to the government, and it requires nothing more than using the right type of account. The difference between investing in tax-advantaged accounts and taxable accounts can amount to hundreds of thousands of dollars over a lifetime. This isn't complicated tax planning. It's simply using the accounts that Congress has made available to encourage retirement saving. Something that holds many people back from starting to invest is the fear of making mistakes. People worry they'll pick the wrong fund, invest at the wrong time, or make some error that costs them dearly. This fear paralyzes them into inaction. They keep meaning to start investing, but never quite get around to it. The months pass, then years, then decades, and the cost of inaction far exceeds the cost of any mistake they might have made. Here's the truth. If you follow a simple strategy, investing consistently in low-cost index funds and staying the course through market volatility, you'll do fine. You don't need to pick the perfect fund. Any broad market index fund will work. You don't need to time your entry perfectly. Dollar cost averaging by investing the same amount each month smooths out the timing. You don't need to be a financial expert. The strategy requires no special knowledge or skill. The biggest mistake is not starting. Every month you delay is a month of compound growth you'll never get back. A 25-year-old who waits until 30 to start investing loses 5 years of compounding that can never be recovered. The numbers assume starting immediately. Waiting even a few years dramatically reduces the final outcome. Start now. Start today. Start with whatever amount you can afford. You can always optimize later, but you cannot recover lost time. Lifestyle and spending are intimately connected to your ability to invest $500 per month. The people who successfully build wealth aren't usually the highest earners. They're the people who maintain a gap between what they earn and what they spend. They live below their means. They avoid lifestyle inflation, the tendency to increase spending whenever income increases. They find satisfaction in experiences and relationships rather than material possessions. I've lived in the same house in Omaha since 1958. I bought it for $31,500. I could have afforded any mansion in the world, but this house has been enough. It has been more than enough. The money I didn't spend on a larger house was invested, and that investment grew into something far more valuable than any house could be. I drive a modest car. I eat at the same restaurants I've always enjoyed. I wear comfortable clothes that are far from fashionable. None of this is deprivation. It's simply a recognition that beyond a certain point, spending more doesn't increase happiness. The marginal utility of consumption diminishes rapidly once your basic needs are met. I've watched many people earn high incomes and end up with nothing. Doctors, lawyers, executives who made hundreds of thousands of dollars per year but spent every penny and more. They financed expensive cars, bought houses they could barely afford, took lavish vacations, and accumulated credit card debt. Despite their impressive incomes, they retired with little or nothing saved. I've also watched people with modest incomes build substantial wealth, teachers, nurses, small business owners who earned $50,000 or $60,000 per year, but consistently saved and invested. They drove used cars, lived in modest homes, took camping vacations, and avoided debt. After 30 or 40 years, they accumulated portfolios worth $1 million or more. The difference wasn't income. It was the gap between income and spending. The gap is what creates investment capital. Without that gap, no amount of income is sufficient to build wealth. I'm not suggesting you live in deprivation. I'm suggesting you think carefully about what actually makes you happy and spend your money accordingly. Most people discover that beyond a certain point, additional spending doesn't increase happiness. The third car doesn't make you happier than the second. The designer clothes don't make you happier than quality basics. It's not about the money. That's the most important lesson I've learned about building wealth. The money is just a tool. It's about what the money enables. Time with people you love, experiences that enrich your life, the ability to help others. It's about the security to take risks and pursue dreams, the freedom to live life on your own terms. I've been fortunate to accumulate more wealth than I could ever spend, but the money itself has never been the source of my happiness. What makes me happy is the work, the intellectual challenge of finding great businesses and understanding how they create value. What makes me happy are the relationships, the partnerships with people I admire and trust. What makes me happy is the freedom to spend my days exactly as I choose. Now, a fancy restaurant doesn't make you happier than a good meal at home with people you love. When you recognize this, finding $500 a month to invest becomes easier. You aren't depriving yourself. You're redirecting money from things that don't bring you joy to investments that will provide security and freedom for the rest of your life. Let me tell you what $500 a month can ultimately provide, because this is the real payoff for decades of discipline, financial independence. It's the ability to wake up each morning and do what you want rather than what someone else requires. It's the security of knowing that unexpected expenses won't derail your life, the freedom to help family members in need without sacrificing your own stability, and the peace of mind that comes from knowing your future is secure. When your investments generate enough income to cover your expenses, you are financially free. The job becomes optional. The boss cannot control you. You can pursue work you find meaningful rather than work that merely pays the bills. You can retire early if you choose, or continue working because you want to rather than because you have to. This freedom is available to almost anyone willing to invest consistently for long enough. It doesn't require a high income, nor does it require investment genius. It requires discipline, patience, and the understanding that small amounts invested consistently over long periods produce extraordinary results. That freedom is available to almost anyone willing to invest consistently for long enough. It doesn't require becoming a billionaire. It doesn't require hitting a home run investment. It requires discipline, patience, and the understanding that small amounts invested consistently over long periods produce extraordinary results. When you invest $500 a month, you're not just buying shares of companies. You're buying future freedom. You're buying peace of mind. You're buying options and opportunities that don't exist for people who spend everything they earn. The person who saves and invests has choices. They can change careers without fear. They can start a business without risking destitution. They can help a family member in need without jeopardizing their own security. They can say no to work they find meaningless and yes to work they find fulfilling. That flexibility, that optionality is worth more than any material possession. $500 a month into low-cost index funds, automatic investments on the first of every month, complete indifference to market fluctuations and economic news, and patient accumulation over decades. While compound growth does its work, the strategy is simple. The math is certain. The only variable is whether you will have the discipline to execute it. 20 or 30 years from now, you will look back at this moment as the turning point, the moment you decided to take control of your financial future, the moment you chose freedom over consumption, the moment you started building the life you truly want. That opportunity is available to you right now. $500, one index fund, decades of patience, and a future of financial independence. The path is clear. The only question is whether you will walk it. Start today. Don't wait for the perfect moment. Don't wait until you have more money, more knowledge, or more confidence. The perfect moment doesn't exist. T only now. Every month you delay is compound growth you will never recover. Every excuse you make is wealth you will never build. The mathematics are unforgiving. Time lost is opportunity lost forever. But the beautiful truth, if you start today, if you commit to $500 a month invested consistently in low-cost index funds, you are virtually certain to build substantial wealth. Not might, not probably, virtually certain. The strategy has worked for generations of investors. It will work for you too. Your future self will thank you.